0.15 and 0.2% on those two indices respectively. The Sensex at about 81,100. The small cap index much better, about 0.6 higher. And I think the mid cap index should also be looking up at this point in time. And that's essentially where all the action has been, even though, and this is the third week running, the large cap indices don't have very much to show on them. So, but mid and small caps have continued to, the pace of gains week on week for the last 3 years kept on coming off for mid and small caps as well. But, that's still looking good, relatively speaking, to large caps. That's the heat map on the Nifty. It's predominantly green and there is some red out there as well. Let's do stocks now. Surabhi.
Okay, Eternal is climbing once again. I mean, Eternal has been on quite a spree. So far this month, about 5.5% up. This morning, it's about 1.3% higher. Reddy's is having a very, very good morning. Almost 3% up on Dr. Reddy's. Actually, supply is also not too bad. So some of the pharma names have started off on a positive note. Power Grid, Shriram Finance, Geo Financial, these are some of the other early movers. Trent, HDFC Bank, that's what we have. IndusInd Bank, TCS. So it's a very mixed bag. It's hard to say whether any one sector is pulling away, early on. On the weaker side, what is weak? Axis Bank, SBI Life, HDFC Life, Bajaj Finance. So financials are very, very mixed. I mean, you can't say banks are up or down. It's really all over the place. Tata Consumer, Lever, Nestle. Consumer stocks are down. So that's a early, easy trend to spot. And then everything else is pretty mixed and muddling along. Now the Nifty is, barely holding on to a gain, about 6 points higher. So volatile and not too steady with those gains, at least so far. Nigel.
Well, that's right. In terms of stocks that are reacting to news, NTPC Green, they've signed a PPA with the UP government for around 1,000 megawatt project. And the tariff has been fixed at around 2.56 per unit. So, that's why, in fact, that stock, I think it's moving up. It's up close to around 3%. So, news-based move out here. Newgen Software, they are bagged a $2.5 million 5-year order from Digital Transformation Systems. So that stock as well is up and about, relatively small in size, but the stock is buzzing. IDBI Bank may be, in fact, a rub-off effect from what Lata had to tell us with regard to probable, some kind of leeway with regard to foreigners holding stake in an Indian bank. So that one has been moving well. Today as well, it's up close to around 2% approximately. So big move being seen on that one. The other big winners I can see is Jaycorp. That's moving on fairly decent volumes in the first stake. Purvankara, that's another big winner. Both of them, good moves is what we are seeing. And BSC, oh my God, just take a look at that stock. It's up close to around 3% as we speak. From the recent lows, it's seen a solid rally. So that's clearly the stock that's running on steroids over the last few trading sessions. Big moves being seen on that one. And as we did that market check, on expected lines actually, the Nifty went to around that 24,700 odd mark. And from the top, has seen some come into profit taking. The Nifty Bank underperforming yet again. That's down close to around 50 points.
All right, well, and the Sensex is just about ticking into the red at this point in time. So it's flattish kind of trends as expected and as we've discussed as well. Nifty Bank is slightly in the negative as well. Well, Rajiv Batra is now joining us. He's head of Asia and co-head of Global Emerging Markets, Equity Strategy and Chief India Equity Strategist at JP Morgan. Rajiv, great to have you with us here. Thank you very much. And you're coming back on the program after a while, so welcome. And at the outset, let me say, we hope to see you more often, Rajiv. With that said, what's the dominant driver to your mind for markets here in India, primarily here in India, and world markets as well? There's no dearth of news flow. It's almost head spinning. But what is the dominant driver? Because there is a lot of noise, but there is some signal as well. What's the signal?
No, so definitely with earnings season getting over, markets is looking for fresh catalyst. And I do believe macro narratives over here will be very critical. This week, we are having trade talks happening between US Trade Representative and India. So all eyes will be on them. RBI monetary policy meeting on Friday. like JP Morgan is calling for 25 basis point rate cut, and majority of the street is also discounting that. But any incremental dovish tone or some positive surprise can lead to big upswing, and then followed by macro data point. Remember, since February, we have started seeing green shoots coming in India. In fact, to put cherry on top, this recent GDP print also was a positive surprise overall. So in that terms, if momentum keeps on building on that, India market will benefit. Coming back to the global market just want to hear one news: what is going to happen on trade tariff side. So in that side, if the noise keeps on going down or start looking much more on a better tone, then market will be in much more a happier shape. We have seen recent increase in steel and aluminum tariff that has increased some bit of a risk premium in market. Beyond that, very close eye on the harder data points on the US, particularly employment or non-farm payroll print, which will dictate the course whether US growth is on par or US growth is sliding. So taking all into account, yes, a lot more data watching like central banks we are also doing, and that will dictate the market direction.
Okay, Rajiv, hi, morning. Great to have you on the show today. So the question that we're asking is that where is India in the mix? The answers that we usually get are that the market seems okay, but the flows really haven't building. I mean, they're very patchy, foreign flows. So what is the sense that you're picking up, and what is it that is still making foreign investors maybe a little sort of sketchy on taking that big India call?
So foreign flows is not just to be a concern for India only. Foreign flow is a concern for entire emerging market. You'll be surprised to know, at least in case of an India, we have started seeing some bit of a flow, close to $2 to $3 billion over the last month or so. But when we look at an emerging market, the YTD situation is still negative, where year-to-date term flows are still 15 to 16 billion down per se. So even if money has started coming out from the US, the first stop it has taken is in developed market ex-US. So markets like Europe, Singapore, Australia, Japan, they are the one who have benefited on the first bout of flows which has come in. Now, when you expect it will build and it will then seeping into emerging market, again, the debate comes around whether US exceptionalism there is in place or not there is in place. Once market get convinced, okay, the trade noise is coming down, they start revisiting back the growth avenue in the US, and hence you have seen rally or rebound in S&P 500, Nasdaq, that followed up some amount of a rally in the tech-driven name. In that particular scenario, domestic market like India suffer, or other emerging market where you don't get that consistency in flow. So I don't anticipate this gyration of US exceptionalism is over or is in the process of a slowdown or it is still alive. With this keeps on going, that will impact the flows pattern into EM, and hence it will have an impact on flows pattern on India also. It's not just a verdict on India growth.
Yeah.
It is more on what is the growth differential between the US and the rest of the world.
No, absolutely, and take your point entirely, because that money that's been leaving US shores, Europe has been the first port of call. Do you see that changing anytime soon? Or will this pattern continue at least for the next several months?
It can definitely change. Remember, like people who have shifting to Europe are still taking a neutral kind of a call on the US, and then hence they are taking an overweight bets on European markets. But the day they start getting marginal underweight or underweight on the US, then you can't be just sitting overweight in Europe only, because the allocation is different. If you look at MSCI Equi or Global Index, 65% weightage is US in benchmark, and the rest of the world is 35%. In that, you cannot place all the bets on 15% on Europe if you are taking an underweight call on the US. Then you need to take an overweight call on the entire rest of the world. Hence, emerging market can come into play. Remember, emerging market is not a big bucket. It's like 10% of the universe. So even a few drops of inflows also can make emerging markets fly.
All right. Hi, Rajiv. Good morning. Good to see you in. Nigel on this side. I recall the conversation we had in September 2024. Things were looking up. The markets had run along. Flows were fairly okay. The problem was the fresh supply of paper. And we know what happened from October onwards, and you were sounding a little bit cautious at that point of time as well with regard to the amount of supply because it was draining out liquidity. How are you feeling now? Because in the last 1 month or so, promoters have decided we run the business, but maybe we can book some profits as well. And we've seen some MNCs as well take some money off the table. Your take on this?
Thanks, Nigel. Yeah, the problem which we were facing in October, that problem, small bit sense have started coming back, which can be seen in performance also. Month of March, India rallied and outperformed rest of the world. Month of April, the same story prevailed. In month of May, we went up 1.5% in dollarized term, but we underperformed Asia and the other emerging market. Yes, definitely higher oil prices or even the trade truce benefiting other export nations was a reason, but the key reason have been increase in supply of paper. So if we are seeing increase in supply of paper with markets still lacking an earning growth story, then what will happen? People will start shifting away again from the secondary market towards the primary market or to additional issuances. For both primary and secondary market to do well, we need a double-digit earning growth handle. And that is missing in India for the last 4 quarters whenever we look at their YOY growth. Sequentially, when we look at the last quarter, fourth quarter FY25, sequential growth, it has shown a double-digit handle. But we need on YOY basis and consistently. Then even the supply of paper will be absorbed and secondary market may not get disrupted. Here now people have an excuse that I can take money off secondary market because you don't have earning catalyst. And yeah, because of better valuation or liquidity availability, let me shift back to primary markets.
Do you see that changing? Rajiv, same question like the flows question. Take your point entirely. I mean, there's no debating that, right? Earnings have disappointed. This is the first quarter. Fourth quarter was the first quarter. We didn't get big downgrades. In fact, if anything, there were pleasant surprises. Do you see earnings coming back in India?
I'll say definitely yes, it is coming back. This is not something new we are seeing for first time. Over the last 2 decades, we have seen how the policy cycles and how growth reacts to the policy cycle. So historically, it's take a 2-quarter lag for growth to rebound in terms of a lag impact when monetary policy changes the course. This time, if you look at the rate cut situation or liquidity injection, that was the story of around January and February. By that means, growth should have appeared in the June quarter itself. But here we have to give them benefit of doubt and say it could happen with 3 quarters lag because at the same point of time, you are seeing external slowdown happening. So taking that lens into account, I still believe it will be a story of a September quarter, which will be an asset test too for our earning growth to appear. But in this June quarter, you will get another benefit beside all the policy actions, plus you can say monsoons getting better over there is base effect. Remember, first half, whether you look at the first quarter FY25, second quarter FY25, your base have been quite low. So with growth data points reciprocating plus base effect, you may start getting into 10 to 11% growth handle, but either it will be first quarter FY26 or it could be the second quarter FY26.
Yeah, no, absolutely. And I think that's well put. Rajiv, in terms of flows, right, which are coming into, so this is feedback that we have gotten recently as well, that, most of the money which we get, foreign money that we get is through global emerging market funds. I think we've spoken about this in the past as well. Global funds, big global funds have got very little exposure. But that is starting to change apparently over the last maybe 1 year, maybe the pace has picked up. What is your sense? What can you tell us?
No, so definitely it can pick up. Right now, when you look at the current situation, it does not show that global investors are fully back into India over here. And we have seen what our banking sector have seen in terms of an outflow during the month of January. And that huge amount of a banking sector outflows was nothing but linked towards these global guys were saying final goodbye to India because of growth being missing over there. Now with the same kind of a global guys coming back in search of a growth, their first stops have been banking and the financial financial industry, and hence you have been seeing last 2 month, 3 month, or you can put 6-month lens also, taking domestic flows into account, that banking sector has making a comeback. So very anemically, they are making a comeback. Remember, India is no longer in global benchmark, also few basis point market. India is now sizable 1.5-2% kind of a market in global benchmark too, which means rather than just owning India through passive route or owning them through one name, now you need to own at least 2 to 3 names per se. But is it happening currently at this juncture? No. Are they doing their studies, analysis to revisit India's story? Absolutely, yes. Everyone has started working on. With question mark appearing of US exceptionalism, people are looking at multiple growth avenues. With 1.2% real GDP growth, you cannot be sufficed with the Europe. India, with offering you even in the range of 6-6.5%, have become a beautiful story for most of my global investors. But it will take time. It cannot happen overnight. You need to give them 2 to 3 years to become an overweight in the global benchmark also. The first stop will be Asia and EM benchmark, where we need to become overweight again for fund manager brigade. And then we can think about IFA, that is global ex-US, and then global benchmark.
All right, I'm feeling good, Rajiv. I'm allocating my money to the right place then, because I'm hoping that in the next 10, 15 years, the kids will be proud of me. That said, Rajiv, I want to ask you how you're feeling about the markets. Headline index seems to be okay. But, when we spoke sometime towards the end of last year as well, you were saying there is signs of froth in the mid and the small caps. And that's the way it played out. We saw a sharp pullback, but plenty of stocks now have started bouncing back. What's your sense with regard to this mid?
Nigel, answer to all this question in India is never a valuation. It's all the growth. India's story started getting question mark because it was growth that has started coming down, and growth came down because of a twin policy tightening. Out of that, partially we have already seen policy reversal have now happened from a monetary side, and fiscal will see how things pan out in future. Now, taking that into account, yes, in case of a mid and small cap, think about if the quarterly growths were getting to single digit or even a negative zone also. Why this mid cap and small cap are making comeback? Look at the fourth quarter earnings season, where growth are again looking in high teens, double digit handle at a broad index level, but led by selective groups of stocks or sectors and the themes per se. So if growth continue to persist, which I do believe, then definitely mid and small cap make a comeback. But in terms of a preference and bringing in not just the growth, but even the global value investors into the play, large cap is looking much more lucrative because we are 12% above average valuation versus mid and small cap, all thanks to recent rally. We are now 35 to 40% above average valuation mark. So value guys may not appear in our mid and small cap spaces, but they will largely go with the large cap only. But growth guys, where the good news fourth quarter have shown us, if that continues for coming 2 or 3 quarters too, then I believe mid and small cap will make a comeback again.
Okay, all right, got that perspective, Rajiv. So earnings just have to revive, and you think that, that could be around the corner as well. There are lots of tailwinds that seem to be adding up. On that positive note, we'll wrap up this discussion. Thank you so much for being with us. We look forward to the next one soon enough. Well, with that, just a quick glance at the market, which continues to consolidate, but the bias once again has turned positive. So now the Nifty is cruising along. We've got about a 100-point up move on the index, and actually the Nifty is doing better than the mid-cap index for the morning at least. So it's looking good, and it seems to be advantage bulls. Well, with that, let's move on to the next theme that we have chosen to focus on today. Today is June 5, which means it's World Environment Day. And this is, of course, a day that's observed around the world. So we thought it's a good idea to put the spotlight on India's own tryst with the energy transition story. Where are we? Are we moving along as quickly as we would want to? What are the roadblocks? And what lies ahead for investors? How can they better participate in this entire story? Vinayak Chatterjee, co-founder and managing trustee of the InfraVision Foundation, is with us. And we have with us Nikhil Nigania, director, senior analyst at Bernstein. Gentlemen, thank you so much for being with us. Nikhil, I have to start with you because I opened your recent note, and there could not be a more catchy title. And for the benefit of our viewers, I want to say this is the latest Bernstein note. And it says, is energy transition really a green scam? And are we set for a second coming of thermal? Nikhil, start there. Why do you say this? Why are you raising this question? Yes, we might be behind, a little slow on that target of 500 gigawatts of renewable power, etc. But a green scam, really?
So yeah, I mean the title is actually a statement by the U.S. president. That's why the title came. I think the statement was more by him. That is energy transition a green scam? Or even a Chinese.
Okay, globally you meant. I thought you meant for India and our targets. Got it. So you were paraphrasing the U.S. president. Go on. And we know where he stands on things like global warming and energy transition.
When you prefaced the question, I was thinking, in Trump era, is it still called World Environment Day?
That's actually true. God knows. Should be the fossil fuel day, right? We should be celebrating that. But anyway, Nikhil, go on.
Correct. So in the case of India, at least our stance has been quite clear, and rightly so, right? I mean, climate change can't be denied. And India has been very forthcoming in pushing the green agenda. The 500 gigawatt target for 2030 is sort of percolated within the industry across ministries as well. Where do we stand now? As of now, we have about 230 gigawatts of renewables, which is including hydro, solar, wind combined. Globally, that puts us on number 3 in terms of renewable capacity. So we have not done that bad. We have done quite well, actually, in terms of renewable capacity addition. The way forward, though, reaching 500, our view, it's not an easy task. There are multiple challenges, largely on grid evacuation being the number one. And second is land availability, large contiguous land parcels for solar and especially wind assets, which we see as roadblocks for us to hit the 500 gigawatt number that we have planned for. And the second part of the statement of the title you mentioned is there a second coming of thermal? So in terms of investment as well, our preferences have been consequences of renewables rather than renewables themselves. So investing in the grid, which is a constraint, or investing in thermal, which is necessary as well from an investing standpoint.
Sure. Okay. Let's bring in Mr. Vinayak Chatterjee as well, of course, a veteran watching the whole infrastructure space and, of course, within that power. Sir, what would you say? We know that there are roadblocks in terms of the grid capacity, like Nikhil mentioned, how to ensure that we get renewable power at the peak evening hours. That's where the battery storage systems become so important. How do you rate where we are at and what needs to be done to expedite things?
Look, I think on World Environment Day, the broad fact is that India is well set. If you recall, at the COP26 in Glasgow, we had made a commitment of net zero by 2050. And as Nikhil just said, we have a capacity target of 500 gigawatts of renewables by 2030. The pace at which things are going, there is very high probability that we will meet both these targets, the near term and the long term. Interestingly enough, while we traditionally define renewable as wind and solar largely, as well as nuclear, and these need to be brought into the discussion now. Many large corporates, Reliance, L&T, etc., are all having fairly substantial backroom project operations on moving into electrolyzer, captive generation for green hydrogen, etc. So we have to count that in green capacity. However, even closer is the recent announcement about small nuclear reactors or Bharat nuclear reactors under PPP mode, which the government has announced. And there we have, again, a very happy target of 100 gigawatts of nuclear power. Now, nuclear, across most analysts, and Nikhil can vouch me on this, is nuclear is also considered not just clean, but is also considered green because it does not emit fossil fuel, gases, emanating gases. So all said, we are well set with the addition of both of these. If you asked me about challenges, the real challenge is to find a fine balance between coal thermal and renewable. If you recall, last week, the headlines were full of a very major breakdown in Europe, in Spain and Portugal, where suddenly something happened to renewables and the system crashed. And the discussion came back to saying that we must have a confident base load level of coal thermal and build renewable on that. And I think with that story and India's growing consumption of electricity, thanks to the economic growth, I think the discussion has come back once again to not completely shunning coal thermal, but building fresh capacities in coal thermal so that there is a fine balance in the entire system between baseload and renewables. And finally, to wrap up the other challenges on renewables right now is very simple. There are PPAs that are waiting to be executed, and project developers are a little worried about the pace of signing and implementation of PPAs. Storage is an issue between pump storage and batteries because many of the bids that are now coming are for 24/7 power. So we have to very, very quickly gear up our storage infrastructure. If there's going to be 500 gigawatts of green energy by 2030, we need minimum 200 gigawatts of storage. Then there is the issue of grid connectivity. And then there is the issue of tariff, the global tariff war, the uncertainty regarding import and export of many solar and wind equipment. So let me stop here.
Right. No, absolutely. By the way, on that, Mr. Chatterjee, morning, Prashant here. Nikhil, good morning to you as well. That target by 2030, does that include renewable as well, Mr. Chatterjee? The nuclear as well? I mean, a certain...
No. That target was decided before this big push in nuclear happened. So the nuclear policy is an add-on, but assuming the target remains the same, then it increases the probability of meeting the target.
Yeah. On a side note, it's always debatable, right? Is nuclear is obviously not. Is it renewable energy? Because it's not renewable exactly, but it's recyclable. So I guess it's
on
clean.
World Environment Day, it is certainly green.
It's green. I think that's what matters. Nikhil, the latter part of the answer where Mr. Chatterjee highlighted some of the challenges, right, with regards to PPAs, etc. What's the state of play? Because you are in touch with pretty much all companies here building out some of the solar and wind capacities. Can you take us through it?
Yeah, so challenges on renewables, as I said, one is on the execution side, where grid and land become the constraint, and second is on a future pipeline side, whereas Mr. Chatterjee said the PPA signing has slowed down a bit. That is a concern. But if you think of it, India tendered a lot of renewable capacity last 2 years. That's primarily the reason why PPA signing has become a bit slow. That combined with power demand softening the last 2 months, and even merchant power prices falling to zero, we saw a week back or so. So these three reasons, a lot of tendering, slower power demand, and low merchant prices is why PPA signing has slowed down. But it's only a function of time. It's a year or two out. I think we'll again see the pickup on PPA signing. So personally, we are not too concerned on PPA signing near term. But yeah, execution side, evacuation and land, that's a bigger concern for this year and next year is what we see for the space.
Nikhil, from the investor's perspective, it just boils down to how do I play this cycle? And if someone's willing to sort of be in it for at least 2-3 years, then do you see enough opportunity in current listed players? The thing with the solar guys, I mean PVs and modules, etc., is that there's constantly a lot of talk of overcapacity and what if China starts dumping around the world, etc. So what part of this story do you prefer? Solar, wind, or do you think that the existing large generators, I mean players like NTPC, Tata Power, they themselves have, are setting up substantial renewable power, even nuclear in some cases, for instance. So what's the best play for an investor?
So from an investor standpoint, one can, within renewables, one can look at the equipment suppliers, as you rightly mentioned, the solar manufacturers or the wind equipment suppliers, or the utility players which are there. We, on the module manufacturing side, we do see a supply glut a couple of years out, and the valuations to be rich. Hence, that's one area we are underperform and not very optimistic from an investment standpoint. Even on the renewable developer side, the valuations are not cheap. Hence, that's not a space we are positive either a lot. But the consequences of renewable, as I mentioned, the grid being a massive issue. So transmission as a space is something we like. We are positive power grid and even L&T, I mean, one of the executors helping us build those assets. And beyond transmission, the other consequence of renewable is need for storage, need for thermal as well, which we just discussed. So that's where NTPC comes in with sort of doing both, right? It's doing thermal, it's doing renewables, it's doing storage and nuclear as well. So that's where we, that's what we like as a space, transmission and NTPC like a thermal or a conglomerate building across the value chain.
All right, Nikhil and Mr. Chatterjee, thank you very much. Quick conversation, but of course, I mean, it's an ongoing one. Appreciate it very much here on CNBC-TV18. Well, I think a market, by the way, just look at the Nifty, is taken off like a rocket. Initially there was a bit of a dip. The low today was made at 24,613. And we are about 120 points off that level. Actually, we're up 120 from the close yesterday on the index at this point. And our market breadth is very healthy, almost about 4:1 advance to decline ratio. We take a break. We're back. We have the management of JK Cement to talk to us about the quarter gone by and their outlook. Stay tuned.
Welcome back. Well, let's focus on a domestic theme. That's cement. JK Lakshmi Cement, that's the next management on our radar. It reported a solid set of numbers in Q4, and the street is optimistic on prospects of FY26. Mr. Arun Shukla, the President and Director of JK Lakshmi Cement, joins us on the show. Hi, Mr. Shukla. Good morning, and thanks a lot for joining in. Well, tell us, what were the signs in terms of demand on ground, as you started off this quarter? And this early monsoon, has it spoiled the plans a little bit? What kind of a volume growth can you deliver in FY26?
Good morning, Prashant, and thanks to you for having me here today. Yes, we had a very good quarter last quarter, and things have started, moving well from third quarter on. As far as demand goes, I think things are all right. Typically Q1 is good, and despite early monsoon, I don't see any kind of setback in terms of demand. So things are all right on demand.
All right, Mr. Shukla, this is Nigel on this side. Just wanted to quantify that. If you could quantify for Q1, what kind of a volume growth have you delivered? The same quarter last year was obviously on a low base. We had elections and, various other problems. But for Q1 so far, what is the volume growth? And for the year, you've been talking about outbeating the industry. So what kind of volume growth should we work with?
So, Nigel, I think Q1, I think last quarter, the same quarter last year was not good because of elections and capex has got delayed. But Q1 looks to be good, and we see that industry is going to grow at the rate of about, let's say, 6-7%, and we are going to be in alignment with that. Maybe I think we'll do a little better than industry.
Got it. All right. You'll do a little bit better than industry. Let's focus on pricing then. The positive surprise in your numbers was even on pricing on a sequential basis. I think you had close to around a 5% recovery in pricing on a blended basis. How do you manage that? And also, when you've joined us in the past, you've said your focus is on increasing the premium segment as a percentage of trade sales. So what is the number at currently and where is it headed?
So premium, Nigel, we are at 25% of our trade volume and we are doing very well. Perhaps we are the best in the industry in terms of premium volume. That is one. I think we have been doing a lot of activities in terms of, improving our, top line and hence also the price which we get from the market. Just to let you know, in the month of January, we launched Green Plus brand, and perhaps we are the first one in the industry to launch a green cement, which is having the least clinker factor. So that has also helped us to improve our price positioning in the market, and hence also, in terms of price growth with respect to previous quarter.
Okay, all right. And from 25%, where will it go with these new launches? Do you see scope for improvement in this year itself, and maybe in a 3-year time horizon? Where is it gone? Where will it move?
Our plan is to take it to 30%, and I'm talking about premium product, and we call it Pro Plus cement, right? JK Lakshmi Pro. And Green Plus is our base brand, right? So a major volume comes from Green Plus. And the premium product, which is JK Lakshmi Pro Plus, is about 25% now. We are going to take it to 30% in maybe coming 1.5 to 2 years' time.
Okay, and the pricing difference between premium and normal sales is how much?
On per bag basis is about 25 to 30 rupees in different markets.
All right. And I think your core markets will be North, Gujarat, and I think parts of East as well. In these markets, if I compare the quarter one of this fiscal average, in comparison to quarter four, is there a pricing difference? If yes, what will blended realizations look like? Will it be higher?
Prices are flat. If you look at quarter four prices last year and quarter one this year, prices are almost flat. Prices have not gone down, but at the same time, prices have not gone up as well. So I see that prices are going to be about range bound only, and I don't see that it's going to be a major increase over the last quarter in terms of pricing.
Okay, pricing flattish. Let's talk about the other part then. On the cost side, you all have been focusing on green power, renewable power as well, and that obviously helps the cost of production come down. For this year, what kind of cost of production reduction? That's FY26 and FY27 as well. You have some kind of a plan. So on a yearly basis, how much will cost of production reduce? Because that's in your hands, right? Cement pricing may not be in your hands, but what you can do internally, that's what's going to help you in terms of profitability.
Absolutely, Nigel. I think this is what we have been doing before, right? So we are working inwardly, and if you look at the EBITDA per ton gap, which we had with the leaders in the industry, now we have bridged it up quite a bit, right? And we have been working internally and particularly on efficiency part of it. On the renewable energy front, we are doing quite well. We are already at about 50% when we exited last quarter. Our plan is to take it to 53% by end of FY26. So this is one major actions which we are taking. Second is, of course, I think I told you the brand rejuvenation which we have done. Green Plus we have launched is doing very well, and also premiumization of our product in the market. So that is second thing. Third, of course, we are doing on the non-fossil fuel uses. We are already at about 10 to 11% on a unsold basis. Our plan is to take it to 15% by end of this year. So I think we are taking a lot of actions on efficiency part of it. Not only this, we are using technology to improve energy efficiency and throughput in our kiln and mills. So we have deployed algorithm and AI module in different plants. And on supply chain front, we do have kind of end-to-end digital integration, and by which not only we are giving differentiated services to our customers, but also we are trying to kind of make our value chain more efficient. So I think all these actions which we are taking now.
Focused on pricing, focused on cost of production, which brings us to the goal. EBITDA per ton. Last year you did ballpark around 650 rupees per ton. This year, given the measures that you're taking, should we work with an EBITDA per ton of around 850 rupees per ton? Should that be a fair number?
So I think we are doing quite a bit. I think the plan which I just enumerated, I think is going to give us about maybe 75 to 100 rupees a ton on internal efficiency, right? And if prices are going to go up, then I think that is going to over and above.
So 200 rupees per ton improvements is okay for us to work with?
I think 1 year time horizon, 1 year FY26 exit, we see that improvement of about 75 to 100 rupees a ton, internal efficiencies.
Yeah, but then there'll be pricing as well, right? So we should work with around 850 rupees per ton of EBITDA?
I think we are quite optimistic. The kind of actions which we have taken, which I told you, is going to give us definitely a good improvement in terms of EBITDA margin.
All right. Very quickly then, by when does that merger take place between Udaipur and JK Lakshmi Cement?
So that is at a very advanced stage now. Maybe I think it will take another couple of months.
Okay. And what about the debt in your books? Currently, what is it? And given that you have an ambitious plan to move from, I think, 16 million tons, you're going to be moving to around 22 million tons in the near future. And then the ultimate target is 30 million tons. Could you quantify the absolute debt currently on a consolidated basis? And where is that headed?
On sold basis, we have a net debt of about 1,300 crore and net debt EBITDA is about 1.51, right?
Okay.
And yes, I think we have a plan to go to 30 million ton, but maybe within next couple of months we'll reach to 18 million ton because we are expanding one of the plants grinding station in Gujarat. So that will take us to 18. And along with that, the 4.6 million ton which we have announced that will take us to 3 million ton.
Very quickly, sir, in the next few days, it's going to be a cutoff with regard to bidding for JP's asset. Are you all interested? Have you all submitted a bid?
So I think any opportunity we look at from a strategy point of view, And perhaps I think this is not fitting into our overall strategy.
Got it. All right, we'll leave it there. Thank you very much for joining us with that perspective. Appreciate it. Well, let's move on. Now, the topic for auto industry globally, of course, has been China refusing to ease its export restrictions over the supply of rare earth magnets. This has been a concern for many global OEMs, and they've been saying, well, we are weeks, maybe a month away from a large-scale production shutdowns. Remember, it was in April of this year that China implemented export controls on medium and heavy rare earth magnets. And China does not control all of the rare earths themselves. It's the processing capacity which China has. Now, by some estimates, inventory with companies was about 2 to 3 months. Since these restrictions came into effect in April, I think it's about now, that is in the month of June or July, that inventories perhaps start to run out. So let's get some perspective going on this particular topic now. What we'll do is, before we go across to our guests, let me just play out some of the views that we got from companies like Mahindra & Mahindra, Tata Motors and others, and then we'll bring in our guests this morning.
The whole supply chain of the world resides in China. So if this is true, we are still trying to come to terms with the facts, all the facts. But if this is true, it would mean that, and if it doesn't change, then in a matter of weeks, the entire Indian EV industry will grind to a halt.
I would be wrong in saying that we don't have dependence on this. There is dependence. As SIAM president, SIAM as well as ACMA both are very closely interacting with the government. Government has been very supportive on this issue. In terms of reaching out to the Chinese government also, the relevant ministries there. And we hope that the issue might be, taken care of.
This EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading two-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
Okay, let me welcome in our guests now. Mahesh Babu is CEO, Switch Mobility. We have Hemal Thakkar, a Senior Practice Leader and Director at CRISIL Intelligence. Gentlemen, good morning. Great to have both of you here. And I think you heard from pretty much the top guys in terms of auto companies there. Mahesh, let me start with you. Is it starting to hit? Will it start to hit? How far out are we in terms of, some of these disruptions, production disruptions coming into effect?
Prashant, first is not only India. I think we should understand that the whole world is affected because China has brought this across Europe, US, India, and other countries as well. So 70% of the mining of rare earths are done by the Chinese companies, and almost 90% of the refining is done by the Chinese companies. So the world is dependent about 90% on supply chain from China. Now, in April, China has introduced a policy of licensing to export rare earth magnets and to the country. So auto industry have been working. The procedure has been kept about 45 days. All our suppliers have applied already, but unfortunately, we heard we'll have to apply through some Ministry of External Affairs about 20 days back, and our suppliers have again applied. So it's a question of disruption right now in a short term. We also have to think about long term because if 90% of the rare earth magnets are going to come and India has a vision of sustainable mobility through electric, then through Atmanirbhar, we'll have to, as industry, look at mid-term, short-term and long-term perspective. So short-term, the industry has to work with both the governments to see how the licensing process...
Right. So let's just break it down a little bit, Mahesh. First up, where are these magnets used? Is it more used in two-wheelers? Is it more used in four-wheelers? Is it used in both? What about EVs versus ICE? Is there a differentiation used in one or the other or both? And are these critical that that vehicles can't be produced, or can vehicles be produced without them?
Most of the permanent magnet synchronous motors, which we call as PMSM, is almost 70% of the motor production, which is the main drivetrain. Both in you can take across two-wheelers, three-wheelers, four-wheelers, and commercial vehicles. Almost 70% are permanent magnet synchronous motors, which needs rare earth magnets because it is high temperature resistant magnets and they need it. So almost 70% of the industry on PMSM is dependent on it, mainly the drivetrain of EVs. Apart from that, there are also other motors across the vehicles which are maybe less sensitive to rare earths, but still needs magnets on it. So the whole supply chain of magnets and rare earth minerals are dependent on it. So 70% of the whole EV industry, from two-wheelers to commercial vehicle, everything is affected due to the supply chain disruption in the magnet.
So it's not it's critical. It's at the heart of motors, etc. So without it, there is no production possible across two-wheelers and four-wheelers, right? That's essentially what you're saying.
Absolutely.
There were some news reports suggesting that with these licenses, it's eased up a little bit for companies in Europe, etc. In terms of Indian companies, we've not seen anything yet.
So the procedure for application just got eased out. Everybody was hoping, our suppliers were hoping that they will be able to complete the process by mid of June and end of June, because they started in April. So some of the companies across Europe, US, India, everybody is trying. I think it is in a sequence which is getting approved. The challenge is uncertainty. If it gets approved and the supply chain starts by mid of June, I don't think any disruption for our production at least will happen between July and going forward. But however, this uncertainty has created a lot of supply chain challenges. If it happens, we welcome. If it doesn't happen, then the situation is it's going to take another 30, 40 days, and there is going to be a disruption in the manufacturing. The manufacturing line of automobile includes many manpower. So if you look at auto industry fully, and particularly EV with about 2 million plus vehicles being sold last year, it will easily to 1,000 to 3,000 manpower will get affected if there is no supply chain disruption directly, and indirectly many more will get affected. So we need to be cautious of that and then take action on short term to get this process done. As told by the other people, through CM, through FICCI, through other auto bodies, we have been working with the government, and government have been supportive. Now we hopeful we will debottleneck in a couple of weeks.
Thanks for that perspective, Mr. Babu. I mean, there are some reports indicating that I think China wants to have a better tracking mechanism and therefore continuous reporting from companies that indeed get the licenses for these magnets. Let's see how this plays out. Let me bring in Hemal Thakkar into the conversation as well. Hemal, what is your assessment of the situation? Mr. Babu just told us that, I mean, these magnets are so critical that you basically cannot manufacture without them. So there doesn't seem to be any workarounds or a go-around. What would your assessment be of the current level of inventory? I don't know if we have even worth of how many weeks, and what happens from here on?
Yeah, so thank you for having me. I would actually tend to agree to what Mr. Babu said and what even Shailesh mentioned. You can't run away from the fact that there is dependence. But I really don't see that, this is a situation to panic at this point of time. Our internal assessment suggests that, in June, we may not see much of an impact. We are relatively good, from a June perspective. But if this gets further prolonged, then, we will see more impact from July onwards. Again, when we look at segment specific, we feel two-wheeler ICE and three-wheeler ICE will probably have the lowest impact. But, when it comes to EVs, we feel that the electric vehicle will possibly have a higher impact, especially where PMSM motors are used. Because today magnets are used in many applications within, the automobile. But for other applications, if they are not rarer, you can still live with it and you will still be in a position to manage them. Also, our interactions with many manufacturers indicate that, there is a workaround that they are trying, but, it will take some time for some breakthrough to come in. So, over the next 4 to 6 weeks, if we do not see a major resolution on this front, then we are looking at we are staring at a problem.
So by July, if there's no breakthrough, then by July, this could start hurting. Anything additional you want to add on the bit of the workaround? You know, in India, they say that when we have our back against the wall, we come up with all kinds of innovative solutions. So this is more the four-wheeler manufacturers. They are thinking of the workarounds, or is it the two-wheeler guys? I mean,
Everybody will think
what are you hearing?
Everybody will think of a workaround because they would want their production to go on,
Yeah.
I can see Mahesh laughing, so I'm sure, even they are looking at something, where they would want to have a workaround, but, workarounds cannot be done overnight. There is reasonable time that they will have to spend into it, to ensure that a resilient supply chain is built. And I would tend to agree to what, Sudarshan also mentioned earlier. This is, a clarion call for us to localize more as compared to, what we've done now. And hence, this is very, very critical that long term, from a structural perspective, we will definitely need a workaround.
But Hemal, I mean, it's very true, right? Look at the entire chip manufacturing ecosystem that we're setting up. The birth was, it kind of came from a space 2-3 years back when we had a global chip shortage, and we realized that we cannot be so dependent. For rare earth magnets, I mean, do we have the wherewithal to even set up capacity? Because we need the rare earths first, right? Those minerals first.
Yeah, so same is the case, with respect to battery. If you see, chemicals are something where we may not have access, but we will still be, kind of producing cells. So, from that perspective, yes, maybe with respect to raw material, we may still be dependent, but we can still put up processing capacities. Like Mr. Babu alluded earlier, that 90% plus processing happens in China. So if we are having access to material, 30% which is still outside China, we may still be in a position to make the supply chain more resilient.
Okay. But that panic thing, as they say, right? If you want to panic, panic early. Hemal, in terms of order of impact, you're saying four-wheelers most impacted? At the other end of the spectrum, it's two-wheeler and three-wheeler ICE. Two-wheeler and three-wheeler ICE is what you said, right?
Yeah, two-wheeler and three-wheeler ICE possibly the least impacted. Even passenger vehicles ICE this month, there may not be a material impact. But, in the subsequent months, if, the issues don't resolve, then we may start seeing some impact on ICE. But EVs, yes, from July onwards, if there is no resolution.
No, I'm not talking about June or July, Hemal. As fundamentally, I mean, say, for example, tomorrow, if everybody runs out of rare earth magnets, I'm saying who's most impacted, who's least impacted?
So least impacted would be two-wheeler ICE and three-wheeler ICE, followed by PV ICE, I would say, and CV ICE. PV and CV, you can, have it very similar, but the least impacted will be two-wheeler and three-wheeler ICE.
Okay, got it.
And the top would be a four-wheeler EV, followed by two-wheeler and three-wheeler EV, right? Most impacted.
Yes.
Okay.
Okay, all right. A good conversation, gentlemen, and I think it's something we'll continue to track as we go on. Mahesh and Hemal, thanks very much for joining us. It's a pleasure having both of you here for that discussion. We'll take a quick commercial break here. We're going to come back, and Manisha is going to be with us with a focus on commodities, what's top of mind. Stay tuned, coming up.
Welcome back. Well, let's get you the latest from the commodity markets. We have Manisha Gupta joining in. Manisha, what's the headline? What's the big news today?
Well, I'm looking at the iron ore prices, Surabhi, because this is an area which has seen constant declines in the recent few days. Well, we already are working with the higher tariffs when it comes to steel. And because iron ore is a major ingredient for steel, we have seen prices here continue to decline as well. So when you look at the prices in US, we're trading at an 8-month lows there. And when you look at the prices in Shanghai, we're trading at around 2-month lows onto that one as well. Well, it really has to do with on how you're looking at the markets there. Because when you look at the last 1 month, we've seen the prices decline by 3%. And in this year until now, it's been a 10% of an average decline that we've seen come in for the iron ore prices. Well, various reasons for that. I'll begin with the international markets first. And we are dealing with the 50% tariffs right now for steel. And there also are concerns about China economy. We're looking at weak manufacturing data from China, the lowest in last 2 years. That same has been the case with the US numbers as well, where the PMI numbers were on the lower side, but the jobs data did slightly better there. The street also is looking at expectations on what China would do when it comes to steel production going forward. Markets also are dealing with higher iron ore exports that we're looking at from Brazil, Australia, and there is lower inventories at port when it comes to China. And markets also are looking at further restrictions on steel production in China. Also remember, the realtors have been told to not sell pre-sell homes there. So various contradicting fundamentals is what the street is working with. Having said that, the Indian numbers seem quite on the positive side. We almost are isolated for what's happening in the international markets there. So the steel sector is looking at a stronger demand here. And if I could take you through those numbers here, the Indian steel making capacity right now is at around 200 million tons. Target is, or ambition is for 300 million tons by 2030. And when you look at the iron ore within that, well, remember, India is the 4th largest iron ore miner in the world, and it takes nearly 1.6 tons of iron ore to make 1 ton of steel. So that's the kind of number that we're looking at. This is what we've done in sense of production, 277 million tons last financial year. And the previous one at 289 million tons actually is a record high here. So when you look at the kind of ambition that India has in sense of steel production there, you will need much more iron ore there. Just to reach that 300 million tons, you will need something like 460 million tons of iron ore. And India doesn't have it right now. In addition to that, we also are exporting iron ore right now. So by 2030, whether we start importing, what India does really is import higher grade iron ore and exports lower grade. So there is a lot of mix and match that you would see by 2030. Having said that, this is what the markets do feel about the international iron ore prices going forward. We're trading at around $96 a ton right now, with most global banks and brokerages believing that $95 to $100 a ton is what we could be looking at an average. The only a lower number rather, that I have seen coming in from the markets has coming in from AOCP, or rather Goldman Sachs as well, which is talking about levels of $90, $95 at this year, and even lower in the next year. Westpac, as I was mentioning, 86. They're the only ones talking about 86 and AOC at 80. Apart from that, everybody else believes that it's going to be a range-bound $95 to $100 a ton of an average for iron ore prices this year.
All right, Manisha, thank you very much for that. Very, very informative. We'll take a quick commercial break here. On the other side, it's our segment. It's the economy. My colleague Latha in conversation with Neeraj Seth of Third Investment Management on global yields, rates and currencies. That's coming up in just a bit.
Welcome back to It's the Economy. Well, there is a bunch of economic data out in the United States. The private payrolls, ADP payrolls, have come in at a measly 37,000. Market was expecting 60,000. And separately, the PMI numbers have also gone into contraction terrain. Because of that, we have seen moving down of bond yields a bit to 4.36 from the 4.5% mark. But on a larger scale, the bond markets are terribly worried about the big, beautiful bill, now called, of course, an abomination by Tesla's chief, Elon Musk. Nevertheless, that bill is likely to determine the distaste or the, affection for US bonds by the global investors. And that can, of course, determine how smart money moves and where it moves. To discuss this entire range of yields, rates, currencies, I have with me someone who has followed it for a very long time, Neeraj Seth, founder and chief investment officer at 3R Investment Management. Thank you very much, Neeraj, for coming over to our studio.
Thanks a lot for having me here. It's a pleasure.
All of you guys must have seen Neeraj in his previous avatar at BlackRock, where he managed fixed income for the Asia-Pac region. Okay, Neeraj, my first question is with this big, beautiful bill, which has already passed the House. But now the news is coming out that it is likely to punish OECD investors, foreign investors who hold US bonds. They may be taxed. So do you see that if that goes through, the yields can go to what, 5%?
Well, first of all, if that goes through, it will be really bad for the US fixed income markets. Now, at this point, there's some level of ambiguity around it. And if you look at the projections with regards to what they're expecting from these taxes, it's pretty low, which clearly is not taking a broad-based approach. The key here is if I take a step back and think about what's going on in the US, you have to look at anything coming out of the White House from two different lenses and see where it fits. Okay. One is the fiscal financing, like trying to cut taxes, raise revenues, and trying to get that balance. The second is the whole negotiation tools around the tariffs. To me, the 899, the way it sounds with the ambiguity around it, it's more of a negotiation tool. Obviously, as you said, it's focused more on Europe, UK, Canada, a few countries where President Trump wants to put more pressure. But I can't see this going in the direction of taxing all of the fixed income. It's going to be very punitive for the domestic markets and steepen the yield curve further.
Oh, yes. Now, let us assume for argument's sake that 899 doesn't happen. As you say, that's perhaps more a negotiation tool than a way to draw money into the fisc. What about the broader bill? It is a bill of tax cuts, and that is the core of the bill. That will not go away. Any which way you do the math, the Congress Budget Office has clearly indicated that it is higher fiscal deficit for the foreseeable future and going on rising for the next 10 years. So what happens to the US bond yields?
I think that's a 36 trillion question, given how big the market is now and how much it's growing. There's still north of 2 trillion of fiscal financing required, the net issuance for this year. I think there's a fundamental issue around the fiscal discipline or lack of that at this point and the consolidation path. And the only way I can see that's changing is the bond markets pushing everybody in the corner by, sometimes when you see the moves. So if you see the 10-year and the 30-year treasuries again selling off, that'll put some pressure. But for now, to your point, the direction of travel is certainly more fiscal financing, higher debt to GDP in the foreseeable future, which is not good for the economy.
No, my pointed question is, at the moment, at 4.4 to 4.5, which the bond yields have been at that average from the day Trump was elected, is that factoring in this big, beautiful bill, at least the tax cuts and the expenditure? Or if that actually passes, it'll have to factor.
So I don't think it's fully factoring in at this point the extent of the impact of the tax cuts on the financing requirements. Obviously, the markets move in a more probabilistic weighted way. It got through the House. Expectation is goes through the Senate. As it gets closer to the time for the Senate to vote on it, I do think the bond markets will actually show some signs of pushback. So I don't think we have seen that whole pricing in of the bill in the markets as yet.
Okay. Now, the reason why we're doing all this is to get you back to Asia. If the bond yields in the US look set to remain high, and more generally not very pleasing for investors, we are finding Japanese yields also rising, right? I mean, they're at whatever, highest since 2008, even after falling from 1.5%. Now, where does this leave bond investors? We saw a goodish amount of FPI money coming into India because of index inclusion. Will we see more of it? How will smart money move?
So I still believe that from a fixed income standpoint, the smart money moves in the direction of the positive real yields and the fiscal discipline. If I take those two together, India is a great candidate for investors to still look at, given where the inflation data is coming in a 3% handle and the policy rate is still sitting at 6, which will change tomorrow in my view. But the direction of travel is clear that you potentially will see more flows going in the higher quality, moderately yielding emerging markets. The other element which you didn't touch on, and I do believe it will become a factor as we look forward, is what happens to the dollar. So if dollar sees further consolidation, your case for good quality emerging markets with lower correlation to the US monetary policy actually becomes a tailwind.
Okay. No, actually, you just took away my next question. I was going to come from yields to the currency, and maybe I should have asked you that before we speak about smart money. The dollar, where do you see it? At the moment, at near 6-week lows, about 98.8 is the dollar index. Do you see it moving towards 90? Is there a lot of depreciation waiting to happen?
So currency is always very hard to predict. But if I look through the history last maybe 6 decades, there have been 3 regimes of weaker dollar. It was in 70s, 80s, and then 2001 to 2008. It didn't mean that US economy didn't do well during that period, but dollar did weaken, which was again a tailwind for a lot of emerging markets. Even last big one was 2001 to 2008. I remember it was a golden period for India. I actually think we might have entered a similar regime where dollar has to go more in terms of the weakening. And part of it is not just the fundamental story, it's also how the capital flows move. And with the global investors owning close to 25% of the treasury market, bond market, a big chunk of the US equities, as the reallocation of capital happens, and if you do have all these Section 899, the tariff uncertainties, you name it, all of that what's coming out of the White House, I expect that to actually keep the pressure on both the fundamentals as well as the capital flows, keeping the dollar on the weaker side on a consolidation phase for the next few years.
So what does that mean for the rupee? Because there is another moving part over here, what the yuan does. I mean, we do have our eyes fixed on dollar, but we're always looking over the shoulder and don't want to appreciate versus the yuan too much.
Well, you would see potentially rupee to be in a more stable scenario. You also have the RBI on the other side trying to manage, obviously, the volatility of the currency, if not the level, and in return collecting more dollars as the reserves for the country, which is not necessarily a bad thing, creating a bit more stable macroeconomic environment. So on a dollar INR front, I'm more in the camp that you see sideways to even in case of depreciation, a lot less depreciation than what people factor in and what they have experienced over the last 2 or 3 decades.
Okay. All right. So a repeat of the 2001, 2008
potentially,
period,
yes.
As you pointed out. Okay. Therefore, do you expect smart money to come to Indian equities as well?
So Indian equities, I still think longer term, it's a good place to be. If you look at the world right now, I do think US story continues with regards to innovation, growth, shareholder returns, the focus on the whole return on equity. I think that's going to continue. It's not going away. But when I look outside of the US, the only large economy with a secular growth story is India. And given the performance of the markets, I don't see how that changes in terms of the capital flow. So I do expect the capital flows to stay. Obviously, there's always a tactical element when the markets are expensive. What we saw last year in September, Nifty crossing 26,000, and we saw some outflows. But in a longer horizon, I think the long-term flows will continue towards India.
Okay, yeah, there is the longer-term story, both in bonds and in equity. But I can't let you go without asking you, towards the policy. What do you think is the terminal rate in this cycle? Are you expecting 2 more rate cuts? That's what our poll threw up. But there are quite a lot of people who expect the repo to go to 5/4, and SBI expects even 5%, which means 4 cuts. what would you say, that much of an interest rate differential contraction is possible between India and US?
I do think so. And part of it, what obviously is important here, there are two core factors from a global perspective and the domestic macroeconomic standpoint. From a global perspective, when you think about the US tariffs and the potential impact of that on the rest of the world will be actually left with some excess capacity if the US economy slows down because of the tariffs. That will have a disinflationary impact on the rest of the world, including India. Second, coming back to the India story, which I find really fascinating, we always look at history. But the countries go from developing to developed country only once in the cycle. And the infrastructure built, the overall structural drop in inflation only happens once. So I'm more in the camp that you'll see more than what market is expecting from a rate cut perspective in the next 2-3 years and a lower terminal rate. So I'll be more in the 5% camp than 5.5%.
Oh, that's an excellent takeaway from this conversation. I'm sorry we're out of time and we have to conclude. But, the big takeaway which Neeraj is telling us, and as a long-term viewer of many markets, we have to take this very seriously. There is a reset of Indian macros, which he is hinting at and which is going to attract way more funds. That's a very big positive in terms of India's journey from a developing to a developed country. Many moving parts in the US bond yield story, and the yield at 4.5 is not factoring in all the contents of the big beautiful bill. And finally, smart money likely to chase Indian stocks and bonds given the state of rival markets. Very, very important takeaways from this conversation. Wrap up on Bazaar on that note. Chartbusters coming up after the break.